MarkEdge Advisors April Market Insights. I'm Matt Gordillo, your host, partner and financial advisor, and I'm joined by Rich Lowry, partner and chief investment officer, and Gavin Gowecki, portfolio manager. But first, a word from our sponsors. Well, thank you, Rich. Welcome,
Hey,
Gavin.
Matt. Hey, Matt.
As we always do, we meet every month to go over what's going on in the markets and the economy and how we can better serve our clients. And I'd like to start, as we always do, Gavin, with maybe bringing us up to speed with where we are from last month.
Sure. And let me quickly share my screen here and just pull up this piece for April. Can you guys see that? Or let's leave it like this and see if we can zoom in a little bit. How's that look?
There you go.
Looks good. You guys see that okay? So April, this is our monthly market insights that we send out, and you can find some of these on our website too if you'd like to get caught up, as well as these recordings. And you know what we've been quite consistent in our view on markets. You know, really in April there wasn't a big update. We did want to call out this switch in commodities broadly from moving into a bullish defensive long stance broadly, and in certain submarkets like cocoa, for instance, outright bullish. And so that's been a big shift in April. And you know, that reinforces our view that has been consistent that the last mile of inflation reduction will be sticky. And that's what we've been seeing. You know, Fed Chair Powell at his forum yesterday highlighted that inflation data recently has been not looking so great. The fight against inflation remains challenging. And he reminded us that we could be, you know, at this level of restrictive policy for as long as we need to. So that is the higher for longer view, which is what we've been calling out for many issues of market insights now. And that's the big update for April.
Thank you, Gavin. So, Rich, you know, it's interesting, you know, just 4 short months ago, the Fed was talking about in 2024, we could start to see some rates being cut even as much as 6-7 times. And seems like the markets were off to the races at that point in time. And, you know, now just 4 short months later, you know, Chairman Powell is talking about, you know, maybe not moving rates this year and keeping them higher for longer. And the market's at a 50-50 price if anything will happen by the end of this year. And so it's just the market's going to overshoot news. And, you know, something's coming up here, the Treasury meeting, and a lot of people don't follow that, but it has a very significance on the markets. And I thought if you could give us your take on the Treasury markets or the Treasury meeting and what that means to the markets and our clients.
Yeah, you know, we've said on past meetings that we think that the Treasury has hopped in the driver's seat and pushed the Fed to the back seat. You know, the Fed's not changing rates. You're right. We came into the year with markets thinking they would get 6 rate cuts, and those are now, you know, getting priced out. But where the Treasury matters is they have a ton of bonds to sell and not the same amount of buyers to buy them. You know, so central banks around the world are selling bonds, they're not buying. Commercial banks are up to their eyeballs in underwater bonds. You know, they're not buying. That leaves basically discretionary investors, price sensitive investors, folks like us, our clients, to take up slack. And if government is generating huge deficits, the reason deficits matter now, and for 40 years they haven't really mattered, is number one, inflation is way above. You know, that's a constraint. Interest rates are higher, so the larger the deficit, the more that puts further pressure on the budget. And then you have the central banks that are not buying and commercial banks that are not buying. So at month end, the Treasury is going to release their confirmed they're going to confirm their guidance for second quarter and give us the first glimpse at what the third quarter is going to look like from an issuance perspective. That's on the 30th. On May 1st, they'll say what the composition of that issuance is going to be. And the long and short of it for investors is if they issue treasury bills, that's not really an impact on markets because the funding from that is going to come from the Federal Reserve's that is going to drain bank reserves. So they're going to pull money out of the system. And then when the government does spend the money, it's going to find its way back in the system. But you have a timing difference. It's like the tide goes out and then it comes back in. They'll draw a lot of liquidity out and then through spending, it'll go back into the economy. But that would be a negative liquidity shock. So rather than try to guess what the number is going to be or front run what the number is going to be, we're going to have all eyes on the report. And going into it, we'll have a pretty good idea that if it's above a certain amount of total issuance, that's going to be bearish. If it's below a certain amount, that's going to be bullish. And then when it comes to the composition, we'll have an amount in mind that if they issue longer term bonds above a certain percentage of the total composition, that's going to be bearish. And if it comes in under, it's going to be bullish. And then we'll make adjustments accordingly. But all someone has to do is step back for the last year and a half, or let's just say, not quite a year, from July 31st, quarterly announcement by the Treasury, to October 31st, all assets were down. And the reason why is the Treasury hit the market with a ton of issuance, and a lot of it was long dated. And the October 31st announcement, they went the other way. They issued more bills that was positive for liquidity, and everybody knows what happens. What began to happen the moment after that, hit the wire, markets rallied into year end. January 31st announcement came out. It was slight negative. It was no big news one way or the other. We would call it a slight negative, and the S&P since that report is up like 2%. Bonds are down over that period of time. So this has the potential to continue to be kind of the front and center catalyst because the Treasury is the marginal provider of liquidity, no longer the Fed. The Fed's not going to change rates, and quantitative tightening is on autopilot. So there's no surprise factor, that comes from that.
And when's this meeting, Rich?
It'll be April 30th. They will announce what the total size of the issuance is going to be for the next quarter. And then the following day, they'll give a breakdown of the composition and we'll know, what percent are going to be T, and they give a detailed schedule of 2s, 5s, 10s, 20s, 30s. But the main thing is just what's the composition of bonds that have a coupon versus bonds that don't, which are T-bills. And the T-bills are going to come out of reverse repo, so it doesn't really have an impact. And the more they issue bills, the more bullish it's going to be for risk assets. And the more they issue coupons, the more bearish that's going to be for all risk assets.
That's very interesting. So if I understand you correctly, if they issue these T, almost like a loosening policy, which is favorable for risky or stocks. And if they issue longer term bonds, then that's kind of like a tightening component and pulls money out of the markets and is a headwind for the stocks then.
Pretty much. That's right.
Well, that I appreciate that update. And, I'm sure after the meeting, we'll monitor it and be able to give us an update for next month. And I'm sure the markets will react and be telling us what happened as well. So we'll keep an eye out for that meeting come up later this month. But, one last topic I'll throw out for either one is, it just seems like, we're always dealing with geopolitical risk, but even more so lately, the tension in the Middle East and, Ukraine seems to be on its last legs, desperate for more support from the West. And certainly we just don't know what's going to happen. And, it just brings up a little level of concern. And so if you have any advice for our clients as to how they should behave during, rising tensions like this. I know, Rich, you've been around a long time, seen a lot of different geopolitical events, and anything you guys would like to share. And if it affects really how you guys make day-to-day decisions, yes, no, or indifferent. But we'd appreciate some insights on that before we wrap up.
Well, it's a good question. I wish we had a real good answer that, hey, all you have to do is X, and but I think in general it is, have a plan up front so that you have something to stick with, as opposed to in the middle of some kind of turmoil, try to figure things out at that point. That would probably be the best, most durable advice. For reason, geopolitical tensions tend to cluster in quad 3 and 4. So that's bottom half, with growth slowing. And in a way, it makes sense in that slowing growth means scarcity. People start fighting over a fixed pie because the pie's not growing anymore. And that's where you tend to get, rising tensions. It's true this time around. So some strategy that at least can adjust in the face of, a quad 3 or quad 4, means you already have your risk reduced by some amount, whether or not there were geopolitical, tensions. And if they do continue to arise in those kind of environments, you're kind of a step ahead by, having your risk already reduced.
Thank you, Rich. Gavin, would you like to add anything on the geopolitical things? Any types of behaviors that you would suggest?
Well, I do think it would be interesting because, what we were just talking about in terms of treasuries being bearish and the quarterly refunding announcement, which I think is, like Rich said, in the driver's seat. But then when we think of the other side of which is always what's on the other side, treasuries in a geopolitical event would be seen as the traditional risk-off asset to own. So there would be maybe there's going to be a lot, there's earnings season coming up, geopolitical tensions, the QRA, a lot to talk about definitely by next time. But I think that would be the most interesting to me, is to watch the refunding announcement with the political tensions and see how those two things kind of blend together for treasuries.
That's good feedback.
I would add in gold. Gold has been a great investment, and its price has been, kind of sniffing out rising tensions before those rising tensions actually happen. So investors are front running that, hey, something's going to happen. It shows up in gold rallying, and then after gold rallies, you tend to get headlines of, who's doing what to whom.
Yeah. So it sounds like no matter what happens, there's always opportunities for investors. So we'll do the best we can to take advantage of those things. And gentlemen, I really appreciate the interesting insight this month. And as always, you can follow our information at our website at parkedgeadvisors.com, and follow us on our LinkedIn page, Park Edge Advisors, as well. So with that, gentlemen, we'll see you next month.
All right. Sounds good, Matt.
Take care.
All right. Take care.